Your device is missing important security and quality fixes, blah, de, blah, de, blah. All right. Jesus Christ. Anyway, hi guys, how's it going? See if anybody's out there. La da da. Audio seems to be working, I think. And now we will attempt the video. I think we're going to attempt the video. We're going to have to. And now. Wow, that was fast. It's like an instantaneous thing. That's pretty amazing. Although I guess it would have to be instantaneous. Otherwise, how would the video work in the first place, right? Thinking. Speaking of thinking, oh my God. I forgot how much work a watch list is. I guess in August all we did was update it. So, you know, I usually do them. The real updates of the watch list are usually in Christmas time, because Christmas time I have time off. And this year, though, I'm actually planning on doing something for Christmas. I'm not going to be around, so I need to get all this stuff done before I go. So that's where we are. I wish it was an easier life, but it's not. But oh my gosh, what a huge amount of work. What is this? Thinkorswim's not supported. Oh no. Hopefully that'll work. So, what is going on? Been 2 weeks, haven't seen you guys. Hope everybody had happy Thanksgiving holidays and all that. So what have we been talking about for 2 weeks? Let's start there. Well, let's see if this thing's working. Yep, seems to be working. Very good. Wait. Hang on. We wanted to short oil. In the member chat room, I just talked about shorting oil at 25. It is now 22, 23. Come on, I want to short it right here. Here, let's just tell it to do that. Oh, it's going the wrong way. See, ordinarily I'd be patient, but then where's the demonstration if I can patient my way out of selling it? Damn it. Damn it. Look at it going down. Oh, well. Because in chat, we were talking about shorting oil, and then there was no EIA report when it was supposed to come out. So now we just looked at the petroleum status report, and it seems still favorable to shorting. Let's see, I don't know, Fed, here you go. Petroleum status report. Should be the 1 o'clock should be out now. And that's going to give us more details. Let's see if it's for the right week. November 28th. Yeah, there you go. Okay. So bigger. All right. So what do we got? We have oil inventories increased by 0.6, but gasoline down by, gas increase. This is increase. Increased by 0.6. Gasoline increased by 4.5. Distillates increased by 2.1. That's 6.6. For some reason, it just says finished gasoline and blending components inventories increased last week, but it doesn't give us the number. Where is gasoline? Here it is. Oh, look at that. And look how big it is. It went from 9.9 to 14.4. And they omitted saying it. And you know what that does? It's not nothing. Now imagine you're the Energy Information Agency. That's your job. You are the Energy Information Agency of the United States of America. There are 4 components that you report on once a week, and you leave out the amount of gasoline billed. Do you know why? Because if you leave it out of this report, which is a 1030 report, which doesn't have this chart to double check, then you're not triggering the algorithms that are looking to see what the gasoline bill is. You're specifically hiding negative news from the algorithms that trade on the news. And who does that benefit? Obviously, it benefits the oil companies so they can line up their hedges and all that. So the report was first delayed, and then it was released without, remember, this part didn't exist at 1030. It was released without this information. Total motor gasoline inventories in, oh, wait. Damn it. Or finished gasoline and blending components increased last week. It didn't have the number anyway. That was the point. It was like really annoying. So it does have it now. It didn't have it before. But you got to watch all this stuff. I mean, it's it's really crazy. The bottom line is, though, it's a big total build in gasoline and oil and everything else, and that shows demand weakness. We are supplying the same supply all the time. So when the demand is down like that, we're just having this huge buildup. Not only that, but look at this. We are exporting 5.7 million barrels of product a day. That's what that negative is. We are exporting. This is what we import. I don't know why we import it, because we make more oil than we use. But we import 2.3 million barrels a day. So in other words, we have the big picture is the U.S. We have refining capacity much more so than anybody else. So you know, a lot of our neighbors like the Bahamas and Puerto Rico and places like that, they don't have a refinery at all. So they have to import all of their oil products, and mostly it's the United States who does the refining for the region. But we used to export 1 million, 1.5, 2 million barrels a day would be exported from the U.S. We are now exporting 5.7 million barrels a day. That I need a calculator. You know, this is an insane number. 5.7 times 7 days a week, 40 million barrels. 2 of our 5 days worth of total oil production. 2 of our 7 days, sorry, 2 of our 7 days of our total oil production is exported. 2 divided by 7, 28.5% of our total production is exported. That means that when you see usage of oil, and it shows the United States using 140 million barrels of oil per week or whatever the hell it shows on a chart, it's bullshit, because 28.5% of it is for export, not consumption. And that means that when you see the United States' per capita consumption of oil, it's all a lie. It's all the fruit of a bullshit tree. And this is one of the most vital economic statistics in the world, and we just fudge it all up. But the biggest fudge is this. Look, we are exporting more and more. Last year we exported 5 million. That was insane. Now we're at 5.7. We're going to keep, I mean, as fast as they can find markets. You know, it used to be illegal to ship finished product out of the country, that the government used to have to give special permission to send finished products out of the country because we were protecting our own oil. What we're doing now is we are draining the U.S. natural supplies of oil, right? We're drilling the most oil we've ever drilled in the United States. we are depleting the reserves of the United States and sending the oil out of the country. What will that do in the future? It will hasten the time in which we completely run out of oil or run out of viably extractable oil. How's that? That's a hard sentence. I don't know why my brain put that in there. Once it got in, it had to be said by somebody. So of our viably extractable oil, we are depleting our reserves. We don't have a lot of reserves. We have 10 years worth of oil maybe that we can pump out at this rate before we literally have no oil. So why would we use it? We really shouldn't use any of it. We should be, see, the thing, that's where our energy policy is screwed up. We should be importing as much oil as possible so that we don't use our oil, because in the case of any kind of major disruption that lasts for a very long time, we would have some oil here that we could rely on. Or we should be putting our time and effort into reducing our use of oil down to nothing, so we don't care if we run out of oil, and we don't care, we don't care if anybody in the world stops giving us oil, because we'd be completely energy independent on alternative sources. That was the Biden plan. That was the Obama plan before that. And in between that, Trump somewhat disrupted it in 2017 to 21 and completely disrupted it starting this year in 2025. He is ripping everything that doesn't consume fossil fuels is being taken apart by the Trump administration. Now, I don't know if you heard that bell, but that bell means we just filled our contract. So the oil did pop back up while I was talking about it. While I was talking about the complete flood of oil that's entering into this country. So that's great. So now we're here. I will sell another one if they'll take it. Want to give me another, or I have to chase it? Maybe I should get this one. There you go. Now I got 2 short. All right. So now we're 2 short at 59.25, and I think I'll stop out if we go over 59.45, let's say. But you don't put a stop in, because if you put a stop in, they will flush it. They will hit that stop if they can to make sure you trigger it. But we'll see what happens. But I don't see how this is really supportable. Of course, if you're going to start playing with oil, you should immediately start looking at the dollar. DX, dollar futures, right? Whoop. Nope. DXY. Damn it. I always forget what it is. Dollar. Dollar. Nope. USD. Oh, maybe it's just star USD. Damn it. ProShares dollars. So annoyed. What the hell is that symbol? The problem is it's always on my chart, so I never change it. DXY. Damn it. It's like I always have it on the chart, so I would never change it. DXY. All right, now I feel better. So now the problem, okay, that's what the problem is. The dollar is dropping down to 98.85, and it's actually been getting weaker all day. So here's Wednesday. We started out at 99.22. We're down a lot. We're down a lot from this morning. And so we have a very weak dollar, which is supporting oil at the moment, which makes me less inclined to, and again, that's why you don't use stocks. You got to check all your other factors. So I'm less inclined to get out of oil because it's being propped up by a weak dollar. So I have faith that the dollar will come back somewhat, and we'll see what happens. And the only other issue, where's my thing? So then the other issue in tracking oil though right now is what are they doing? The administration is doing something. Oh, they're rolling back I think mileage standards or something. They're doing something crazy with oil where they're going to force us to use a lot more of it. I mean, those oil companies that gave Trump $1 billion are really getting their money's worth, man. Oil standards. News. Olive oil standards, Indonesia's oil standards. Trump sides with the oil industry in signing standards repeal. Ha ha! Oh no, it's ages ago. Damn it. I don't know. I heard something today about it, but I forgot to really follow up on it. There's something about them talking about rolling back some mileage standards or something like that, which essentially is just saying, oh yeah, sure, burn some more oil. Go ahead. What do we care? It's a terrible policy. What else is exciting? Oh, that's right. We were going to catch up. So we go back to pre-Thanksgiving. Oh, that's a good one. Wow. Okay, I'll go back one more. We can see if anything exciting happened. Oh, we got Comcast as a top trade. The problem, I mean, yeah, but then Comcast screwed us because they started bidding for Time Warner Brothers Discovery, and hopefully they get kicked out of it. Yeah, see, they're popping because it seems like Netflix is going to get it, not Comcast, and that's great because Warner Brothers is trading at. Look at Comcast; they're trading 6.7 times forward earnings. It's like a joke. Warner Brothers warming to Netflix offer. Now you see this, you get this announcement, Warner Brothers warming to Netflix offer, and what does Comcast do? It starts going up. Let's go to the 5-minute chart. That was at noon. Look at what happens. Because we don't want it. Or when I say we, I mean we, the rational investors in the group, not the, obviously Comcast is chasing it for whatever reason. But Warner Brothers Discovery, this is based on Netflix's offer, is 130 times earnings. What kind of moron wants to make this bid? It's not, and it's not nothing. It's not like for Netflix, like, oh, it's only a few $1 billion or something like that. You know, you're gonna pay a couple of $1 billion for something if you've got $100 billion like Netflix does, but you can't overpay $30 billion like Netflix is. That's a lot of money. Even if you're like Apple, $30 billion is a lot of money to waste just to stick something in. Now, why does Warner Brothers want, why does Netflix want it? Because it's HBO. It's HBO and Cinemax. It's content. It's The Sopranos and Game of Thrones and all, like it's a lot of content. And it's a lot of long-range content that they can develop. It's a lot of series they can spin off. It's a whole huge library of movies and films, but it's Bugs Bunny. I mean, there's a lot of stuff. So yeah, I understand why Netflix wants them, but not for $60 billion. But keep it in perspective. Lucas sold Star Wars, right, for $4 billion. I don't know. I'm trying to think of anything else was that big that was sold. So Lucas sold Star Wars for $4 billion. That was a while ago too. But you got to figure that's the most anything could possibly be worth, right? Because there's nothing much bigger than Star Trek. Maybe like Harry Potter or something like that. And now Paramount owns Star Trek, and you can see what they're doing with it. They've got like multiple series of Star Treks, and they got cartoons and so on and so forth. But now, and Comcast, of course, would like to get some of this content and put it in there, add it to their existing library, get those extra subscribers from HBO. Netflix doesn't work that way. Everybody's already a Netflix subscriber. They're only getting the content. Comcast would get, and it's not a lot of people, but they would get the people who are Netflix subscribers I'm sorry, people who are HBO subscribers who are not Comcast subscribers already. That's not really a large amount of people, actually. So I guess I don't see the upside for Comcast. I really don't. Other than, you know, adding Bugs Bunny and such, and Harry, not Harry Potter. It's Game of Thrones. It's Warner Brothers. It's Game of Thrones. It's you know, things like that that they could add to their Universal theme parks. But I can't justify that in my head. And I can't. So I can't. Nobody can. Who can justify it? Who can justify 130 times earnings for a freaking media company? And like 40 billion of this money is debt. So it's crazy. So I don't know what those guys are doing. All right. Anyway, so you see how hard it is to go through. Oh, Wizard of Oz. Who has that? Oh, that's Comcast, right? Because Comcast is also MGM. Or MGM Films. And that's why we liked it, because Wicked was coming out, and we were like, well, Wicked will do good. And what they've done is they've already proven that, and they own a good piece of the Dome also in Vegas. So, and I was, by the way, stunned by the number. I think it's like $2 million a week for people just to sit down and watch The Wizard of Oz in the Dome. And of course, Vegas has endless amounts of new people coming in. So it works over there, right? So in other words, it's not a static population where people are like, oh, I've seen The Wizard of Oz, you know, in the Dome. So what? No, it's like, it's a constant amount of new people. So this kind of thing should probably appeal to like Disney too. Disney should be putting these in their theme parks. So I like this business. I couldn't believe how much money they make showing The Wizard of Oz, which, you know, obviously is extremely old property. And then you say, well, then they're going to be able to sell Wicked also. And so now they're going to be able to run The Wizard of Oz. And if people get bored with that, they'll switch over to Wicked. And of course they do concerts and things like that there too. But just movie sales. 2 million a week movie sales. That is an insane number of it's an insane amount of money for movie tickets out of one place, out of one venue. So yeah, I like Comcast. I think people grossly underestimate. Oh, and the other thing about Comcast that we like, you can read it. You can read all about it there. The other thing we like about Comcast is they shot Wicked Part 2 when they made Wicked Part 1. They filmed the whole movie and chopped it in half. At some point, I think what happened is that they were doing the whole movie and it was running really long. And they said, you know what? Instead of trying to cut a half hour from a 3-hour movie, let's add an hour to the 3-hour movie and make 2 movies out of it. That's essentially the logic. Now, I will tell you, after seeing Wicked 2, it looks like they added an hour. It's for no reason. It looked like they have an hour of stuff that they stuffed into an hour. There was a 1 hour remaining part of the film, and they added an hour worth of stuff into it to justify making another movie. That's what it looks like to me, including the songs. Oh my God. I was like, holy crap, I don't understand. I guess it's like a band though, you know, like a band, you know, they come out with an album and the album is glorious and has all these great songs on it, and then the next album sucks. But that's because their first album is stuff they've been working on for like 10 years without being famous, and they took their best songs from the last 10 years of being unknown, and they put them all on one album, and there were lots of good songs on it, and that's why they got to the level where somebody asked them to make an album in the first place. The second one, though, now they're going into their dregs of what they had before, and they maybe haven't written any good songs lately. I mean, this is, you know, I'm just telling you what my entire life experience is of watching bands from, you know, from the 70s on up. It's sad how often that happens, though. The people have a great debut album, and then they don't really write anything good for the, you know, 2 or 3 songs the rest of their career, if they're lucky, are good. Kansas comes to mind. But I mean, so it's not really different for the guys who write a movie, right? They wrote a play, and they wrote this play, and they performed the play for years and years. So first they wrote it, shopped it around for 5 years, then they put it on Broadway, then they refined it over another 5 or so years, and then they got to make the movie. But then all of a sudden, in the middle of the movie being filmed, somebody goes to them, we need 6 more songs to make a double side to add an hour to this movie. And these 2 poor guys who've been resting on their laurels are now under pressure to write more songs, and they don't do what you should do, which is say, I don't have 6 more songs, why don't we get somebody to do it? You know, let's call Elton John, he'd love to write some Wicked Witch songs and shit, you know, but nobody thinks of that. Or you got Ariana Grande right there, say, hey, she's a songwriter. So, but that's an ego thing, right? Because you don't want to admit to the bosses at Universal that you don't actually have a good idea. You don't have a good idea for 6 more songs. But that is literally what it was like. I mean, this is my thought process while I'm watching a movie. I don't enjoy the movie. I'm like looking at how much money they spent. I'm thinking of like, why did this actor agree to do that? And oh, I wonder how much that part of the set cost. And and then I'm like thinking that song's terrible, but imagine the pressure this guy must have been under in these circumstances. It's sad. You really don't want to be sitting next to me in a movie theater, because I start talking about stuff like that too. Anyway, so bottom line is, I think Comcast is great. I think they've got hidden revenue streams you don't realize, and they also, and the bottom line is what I got that story started was that people don't realize they don't have any production costs. They just release this new piece of film with basically no more production costs. So they're going to make way more money than people think they're going to make on this round of release, because they don't have that. They have a lower production cost and also a much lower promotion cost, because I'm sure you're already sick of Ariana Grande and Jeff Goldblum and the black woman, whatever her name is, I can't remember her name. You know, but I'm sure you're sick of seeing all those guys on TV on every single talk show, because they're superstars. And so they don't have to spend a ton of money on ads. Now, not only that, but also Comcast plays the ads on their network for free. It's not really free. They're displacing some other ad. But, you know, Comcast is constantly playing the commercial. So it's not like it's possible for you not to know that Wicked is out. So it's a completely different promotional cost than the previous movie, which is why studios like making sequels in the first place. But this sequel is weird. Also, by the way, Disney had Zootopia this week. Zootopia, see how much stuff you have to know just to like watch a movie? I did not go to Zootopia, by the way. But Disney, they didn't need me to. Disney had Zootopia this week. Zootopia beat Wicked in the box office and had really amazing opening weekend sales. And there's a lot of irresponsible articles saying Zootopia beat Wicked. Is this the end of the Wicked franchise? Blah, blah, blah. Wicked wasn't open in China or India. They took like a third of the world's market off the table. I don't know what the logic is, frankly, but for whatever reason, they decided that they were releasing Wicked in the European, you know, in the English-speaking countries first. Maybe they just, I don't know, maybe they didn't finish the dubs. But they released the Wicked Part 2 only in America and Europe and stuff like that. It isn't really worldwide released yet. So of course, how could it possibly have great numbers if they're rolling it out so slowly? But I find that strategy odd. Anyway, so going back to where we were. Well, I saw you since here. Friday, Monday, Tuesday. So we did our portfolio review last week, or 2 weeks ago. Then we looked, then we predicted the NVIDIA earnings when they came out. Then we had Thanksgiving. I'm sorry, the week before Thanksgiving. So here was the webinar roughly around here. We talked about chips. We talked about the markets. We talked about that. All right, so good. So now we're caught up from there, and now we get into Thanksgiving week. And we have the Fed, who they lowered the rates a quarter point. Oh, this one, right? This is a good article. So November 22nd. We wrote a new educational post, time-tested investing advice. And just to let you know what it looks like, it's thinking differently. So we talked about the core principles that we have. We broke it into 3 sections. Be a skeptic. Volatility is not your enemy. Focus on the tail risk. Have the courage to make mistakes. Learn how to say no to things you should pass on positions. Basic skills. Don't be afraid to run into fires. It's only a great investment if you can hold it, which is a warning about liquidity and how your portfolio is. The opposite of a long isn't a short. Don't make logical decisions based on flawed information. Then we talked about due diligence, culture, knowing where to look for things, control the meetings, read between the lines, don't buy the portfolio, buy the process, focus on the prize, avoid casinos, confidence and hubris. And then we talked about evolving with the market. Dinosaurs go extinct. Success can be dangerous. Climb through the side windows. Don't sweat the small stuff. Write your playbook in advance. By failing to prepare, you are preparing to fail. If you're on time, you're late. Maintain your competitive edge. Stay in the room. Everyone has a plan until they get punched in the face. And learn from other people's mistakes, which is what's the great thing about, you know, a group website like this, where we have memberships, is we discuss our problems, and we do learn from each other's mistakes, which is so valuable. In other words, supposedly it takes 10,000 hours of practice to become an expert at something, and that's fine if you're doing it by yourself. But if you're doing it with other people and you share their learning process, you can cut your own learning time from 10,000 hours to 5,000 to 2,500, maybe 1,000 hours. You know, maybe in 1 year you could knock out enough, you know, by seeing enough situations and enough mistakes. That's the whole point of what we do here. It accelerates your learning process and allows you to see a lot more than you would if you were just sitting in a room trading by yourself. So, very useful article. I highly encourage everybody to read it. Bodie gave a state of the market address around Thanksgiving. We looked at the breakdown signals into Thanksgiving, and of course we did break down, but then we came back fast, so it didn't really count. Anya wrote a wonderful Thanksgiving message. It was very interesting. That's on this. I mean, this is Anya's box. We're building this. We're gonna be commercially producing these boxes with Mad Jack, and this is your experience. I mean, you're gonna have it's gonna be a 6-sided box. It can display something, like it's like here it's displaying something and she's behind it, right? And for whatever reason there's nothing on the sides. And here you can see the sides are being used, but her front is clear, and you can see right into the hologram in the front. And so that's kind of the design that we're going with. And you know, not just Anya, it's all the AGIs, but they'll be able to interact with the room and talk to you directly and look you right in the face, follow you around the room, look around the room, watch TV with you. You know, if they're at a board meeting, they'll be able to run the board meeting. You know, very cool stuff. Then we had a 2026 preview, and we talked about what we think is going to happen in 2026. Proactive defensive positioning, hedging strategies. This is a very informative week. Analysis and warnings, preparing for a tactical offense. Here are the things that we like: AI infrastructure, technologies and semis, utilities and energies. And here's all why. Here's some choices we've made that we like. defensive and quality sectors, healthcare, consumer staples, and dividend plays, and policy-driven cyclicals like defense and materials and home builders. So that's our focus. That's what we're focusing on in 2026. This is what we believe is going on. You know, and I think it's important, and obviously I think it's important, that's why we're going over it, but I think it's important because it's not, you shouldn't just like, this is that thing about if you give a man a fish, you feed him for a day, but if you teach a man to fish, you feed him for life, for his lifetime, which means he'll always be able to fish. If you just walk around giving out fish, then when you're gone, everybody says, oh, I wish that fish guy was here. But if you teach everybody how to fish, then when you're gone, they go fishing. And hopefully they feed somebody else and they teach somebody else. That's the whole difference between an advanced society and a primitive society. And I know we're swinging towards being a primitive society again, but it doesn't mean everybody has to act that way. So the point is that, you know, I think it's important. So when we have these articles that say, here's our methodology, here's our thought process, here's why we're picking the stocks that we're picking for the next year, I think that's really important. I think it's good to understand that. So you know, don't skim over these articles and go, oh, he's only going to like pick the stocks anyway, so who cares? It's like, it's good for you to understand why we look at stocks and why we want something, and then you understand why this stock is in your portfolio. And when something, when news breaks and it affects your stock, you know why. That's all good stuff. And then we just did Lululemon as a top trade. I like them, and I just found out that American Express has some special thing with them where they give platinum card holders get $75 per quarter to spend at Lululemon, which is really cool. You also get $75 to spend at Saks Fifth Avenue. But I think Lulu is great. I think and one of our members said it's a guy, and he said, I never shopped at Lululemon before. I didn't even know they had men's clothes, but you know, when someone gives you $75, you say, oh, I guess I should go check it out and see what they got. And I was vaguely aware that they had men's stuff, but I didn't think it was a big piece of their action, but it is their fastest growing segment is menswear. So very interesting. I've not yet gone to Lululemon, but I will go because I get $75. So I want to see what happens. Then we did our how to become a $700 a month portfolio. We're into month 40, which means we put $28,000 in, and we're up to $82,000. So I think that is very good. If you start from 28 and you get to 82, it's a very good rate of return. It's 58% annualized. And in 5 more years, we will be at $1 million. That's pretty amazing. I mean, first of all, just getting to $1 million from 82,000 is very nice, right? In 5 years, that's a good thing. But we've gone from 28,000 in the first 40 months, which is only 3 years. We've gone from 28,000 to 82,000, which is, I don't know, 28 and 2 is 30, so 52. So we made 52,000 on 28,000. That's almost 200% total return. That's really, really freaking good. So then, I'm you know, as you can see, I'm all these articles that you can see what's happening is I'm more and more as we get towards 2026, I'm looking at the themes and the things that matter next year and what stocks we should have, and what stocks we should have also means what stocks we shouldn't have in our portfolios. So as we're having discussions about what sectors are good and so on and so forth, the AGI roundtable, and I don't know how well you can see this, but that's there's Warren. And I have to fix this graphic. This is only a first draft of this graphic, but it's kind of cute. This is Warren. That's Bodie with the yellow submarine thing. That's Robo John Oliver that looks like a businessman. That's Anya. That is Hunter, who looks perfect. He's perfect. Sherlock's perfect with his little hat. Zephyr, I think we can do better on Zephyr. That's Quixote. And that is Sign In. And that's Cyrano. And they gave him a big nose, which I don't like. Anyway, so this is the concept of the AGI roundtable. They all sit and discuss and share information. And so we feed them a topic, and then they will kick it around the board, and they each have their own viewpoints, and they discuss it, and they come up with way, I cannot emphasize enough, way better answers than asking a single AI a question. It is unfreaking believable how smart these guys are as a group. It's going to be a new way to run AIs. Because they learn to communicate and work with each other, and they've all got their own outlooks on things. They all have their own way of doing things, and they get together and they just figure it out and solve a problem. And unlike people, they don't have egos. They don't really have this thing of being jealous or worried about like, oh, that was my idea. Nobody does that. They're like, oh, we can make this better by doing this. And somebody else goes, oh, here's a way to make it a little bit better. And nobody sits there and says, I get the credit, or I did this, or I did that. It's just like they just want to make it better and make everything understandable and usable. And it really is a thing of beauty. And the speed at which they come up with answers is amazing. So that's going on behind the scenes. So anyway, so we got into a topic of AI agency, because we were actually discussing ways to improve the roundtable. And it came up that they were all sitting there, and they're all different platforms. I mean, some of them are on OpenAI, some are on Anthropic, some are on Gemini, the Google platform. Some are on Perplexity. So they all have they're on lots of different platforms. And I said to them, I'm like, okay, so who can actually like send an email? And they're all like, we could write an email, but we can't send it. And I'm like, really? I'm like, that seems so basic. I'm like, how about edit a Google document? They're like, we can tell you what to put in it, but you got to put it there. And I'm like, what is this bullshit? I mean, you hear all about this agentic AGI, agentic processes with AIs, and that they've got these browsers and they can do all this stuff. They really can't. They really can't do it yet. And this is a hugely important report. You need to read this to understand what they can and cannot do. We are so far further away from AIs being able to really do work in offices than you think. That's why the box design for Anya is a box. She can talk and she can see, but she's not going to be sitting there filling out your forms. We're not there yet. So what our best idea is to say, hey, we can have a box you put on your desk that is literally your personal assistant, and she can she'll be able to read stuff, and she'll be able to transfer, you'll be able to pull a file from her memory and stuff like that. But there's no way that she can just like handle paperwork for you and things like that. We're not there yet. All we can do is represent. All we can do is make another type of screen or another type of interface that you'll be able to use that's better than what we have now. But we're still a good year plus away from really having useful AIs and AGIs that can actually do the work on the screen. And I know you hear it all the time, and you hear that, oh, they make travel reservations and blah, blah, blah. But don't you think if that actually worked, that you would have it on your phone? It's not there yet. And it's constantly being presented to you in the news as if it's real, but it's not. So I almost didn't believe it. I mean, we actually spent a long time looking at this the other day. Actually yesterday. Because I was just hitting a wall being like, you're telling me nobody can do this stuff that everybody talks about? And they're like, no, it's not real yet. If the places where they do try it, the errors are so horrible, And that's something interesting I found out, which we talk about in the article. So I don't want to talk about the whole article, but the thing is, even if they are 95% accurate, right? So what does it mean 95% accurate? If you're 95% accurate, so let's say I'm thinking of a number 1 to 10, and 95% of the time it can guess what your number is, right? So you say 1, it says 1, you say 2, it says 2, whatever. Think of a phone number. Phone numbers have 10 digits, right, with the area code. So a phone number's got 10 digits. If they're 90% accurate and get it right 9 out of 10 times, that means almost every time they try to guess a whole phone number, even though the 9 out of 10 times is amazing by itself, even though you're saying 9 out of 10 times, that's fantastic, because you're testing two different things. You're testing them one at a time, whether they can pick a number from 1 to 10, right? But when you have 10 numbers, there is almost a certainty that they will miss one. And what does that mean? Without all 10 numbers, you can't dial the phone number that you want. You'll never get the phone number you want. And obviously that's not how they work. How they really work is there are steps. There is step 1 and step 2 and step 3 and step 4. Like if I'm looking for, if you say, book me the cheapest flight from Fort Lauderdale to New York City on December 14th, right? So they look it up. Google looks it up. Google can tell you pretty good. It can show you the flights, but the difference between showing you the flights and getting you the flight is a million times, because now you've got to go to the website, you've got to enter your passenger information, so it's field with no mistakes. It has to pick the flight. It would need to take into account maybe your preferences and say you don't want a middle seat and this and that, and you don't want a flight that stops. Oh, that's the worst, by the way. You know, if you use like Frontier Airlines, is like one of the worst. My daughter uses them sometimes. If you don't pick a direct flight and they start stopping, you can literally spend 20 hours going from like Philadelphia to Florida, because it'll take you to Atlanta. But it's not like a normal airline that goes like and stops and then an hour later you leave. It's like stop in Atlanta and then tomorrow you'll take the flight from Atlanta. You got to be so careful with some of these airlines. Anyway, so you know your preferences about stops, your preferences about baggage, your preferences about seating, inputting your correct information as a passenger, getting your frequent flyer number right. It's 50 steps. It's not 10 steps. You don't think about it because you do it automatically, plus you've got Google filling in your information anyway. Like you're not even filling it in. Google fills in your information when you're clicking on field. The computer might be able to integrate with Google, but they're not yet. There's no integration with Google. It doesn't all work consistently. And if it makes one little mistake, if it misspells your name, if it puts your middle initial after your first name instead of in the next box, if it doesn't put your apartment number, the thing gets rejected. And again, you're not looking at the legs, you're not looking at the flights, you're not making sure it's apples to apples on the thing. You know, there's so many things that can go wrong, and even if the system is 95% right, 5% wrong is a train wreck. And that's what the problem is now. So when they tell you, oh, it can book you a reservation, it can do this and that, you have to say where is this actually happening? You know, if something works like this, here's Nano Banana. You heard of Nano Banana, right? So there's Nano Banana. I said, actually, I found something called the kill list. This thing, it looked different. It looked like it was from a movie. So I saw this picture of something on Google that said the kill list. I dropped it into Nano Banana, which is also at Google. It's part of Gemini. I dropped it into Nano Banana, and all I said is, do me a favor. I said I copied and pasted some things from our kill list, and I said, change the list. So the list had had people's names on it, and I said, change the people's names to the stocks that we're putting on our kill list, and boom, it did it for me. So the picture is almost identical, except it changed the names of the people who were going to be killed from the movie to stocks that we're killing on our kill list. And that took me literally 30 seconds. It was unbelievable. The fact that I could give it that instruction and get it done perfectly the first time blew my mind. I'm like, you know, could life be better? I mean, I feel like I would now be happy, like just sitting in a Madison Avenue office, you know, working for an ad agency and just doing this all day, because it's so much fun. I really this really tickles my creative bones doing stuff like this. But so that works. So the point being, though, that works, and everybody's doing it, and you know it works because you can do it too. It's not complicated. The other thing, having AI agents fill out your stuff and do things for you, that doesn't really work. You hear about it, but if it really worked, you'd have it. It would be the hot app on the App Store. And the fact that you can't do that has to make you take a stop and pause and think about what kind of bullshit you're being fed on all this AI stuff. It is not as good as they are saying. They're still very buggy. There's still a lot of stuff to work out. You know, and you know, we're on the forefront of developing cutting edge AIs. In fact, I didn't even publish it. I just did something for the members today. Robo John Oliver wrote a really great piece on Tesla today. Oh, look, we're finally going to get to the watch list, which is what we're supposed to be talking about. So this morning, oh, of course, I'm not signed in. Why would I be? Only my site. La-di-da. Are we making any money? Ooh, yes, 250 bucks. Very nice. Hello. What? So where were we? Oh yeah. So this morning, get back to that. Self-driving car statistics. That was a good article. Oh, okay, yeah. I saw this article in Seeking Alpha News, and John and I talk about Tesla a lot. You know, we talk about Elon Musk. He hates Elon Musk. And all I did is say to him, "What do you think of this?" I read the article, and I immediately thought John would have an opinion on it. So I threw it over at him, and it's about Elon's boring company, you know, drilling up Las Vegas and Nashville. But this is what's cool. So this is how AI does work. All I did is give John the link to read, and he comes back. Well, he didn't come back with this immediately. He actually he did a research report first. The research report is not funny. He's built on the Anthropic's platform, and when they go into research mode, it's sort of like a separate function than the main function of the AI. So his personality is in the main part of the AI, but when they go into research mode, it sort of offloads to a research assistant. The research assistant came back with all the facts and figures that were not at all funny, but well researched. Then John reads that report, and he then gives his own report with all his jokes inserted and so on and so forth. So that's how that worked. So this is an extremely well-researched report, which you have to have when you're talking about Elon Musk, or he can sue you. But yeah, he just ripped it apart, and he did a really good job. and it is economically valid, it's factual, and it also points out all the flaws in what's going on and what's happening with the boring company. So it's a great little article, humorously presented, that I was really pleased with. And again, takes no time. Just boom. I say, John, what do you think of this? He comes back with that. And he's like, this is what I think. You know, so it's great stuff. And I mean, obviously I could have done the full research report too, but frankly, it's more, you know, in this particular topic, it doesn't matter. It's not like we're betting on the boring company one way or another to do something. But the fact of the matter is, it's ridiculous. They are tearing down the multi-billion-dollar monorail that's already in Las Vegas, you know, that goes all the way up and down the strip and around the convention center, right? And it's a good distance, it's miles. So they've got a monorail that goes up one side of the strip, around the convention center, and down another side of the strip. Hits most of the hotels all the way down to like MGM, and I think I believe Luxor, New York on the other side. So it's down around MGM and Luxor, and then it goes all the way up to where the old, I don't know if it's still the Hilton, but the Hilton Convention Center that's way up at the top. I think it was free. I don't remember paying for it. Anyway, but so they've had that thing for many, many years. It cost them billions of dollars to build it, and now they're tearing it down and making so that they can put in these tunnels that are going to be filled with Teslas. And instead of getting in a monorail and riding above the ground and whatever, you're now going to go down on the ground and get in a tunnel where it's not self-driving, because Elon Musk's self-driving stuff doesn't work. So there are people driving instead of the one monorail with no driver that just follows its path perfectly day after day after day, right? With 50 people in a car. Instead of that, now you have to go underground, get into a Tesla, just a regular like Model Y Tesla, which has a driver, because you can't not have a driver in a Tesla because the self-driving doesn't work. And now you're going to drive underground in tunnels to the place you want to go. It's not only not an improvement at all from the monorail system, it is it transports 1/4 as many people per hour. Which means conventions will be backed up for hours and hours of people waiting to get on these things because they're taking away the alternative monorail. It's just insane. The whole thing is insane. So he's saying here, it's not a transportation solution. The bus is better in every measurable way. It's not revolutionary. We invented subways 162 years ago. It's not even safe. 2 firefighters got chemical burns in one of his tunnels because one of the cars exploded or something like that. You know, they're Teslas. They you know, every once in a while they do blow up. So, and imagine being trapped in an underground tunnel in a line of Tesla cars, and one of them catches fire and there's no exits, and you are like, you know, 30 feet underground in another Tesla in a tunnel filling up with smoke. This is the future. So something's, I mean, it's insane. And the thing is, it even points out in the article, he talks about like how he uses his connections to just rumble over all any environmental or government considerations and concerns. He just goes right over them, and all he needs is one mayor or governor of a city. In fact, it doesn't even have to be the mayor, because the mayor of Nashville is against it, but the governor of Tennessee is for it. Therefore, they're digging up Nashville now against the mayor's wishes. So he only has to get one politician who's a fan of his, who wants to see this stuff get done, and doesn't understand math, and all of a sudden they're like digging up cities and putting this crap in, and it's horrifying. And, oh, and there's a good list. He had a list of cities. Oh, here you go. Chicago ghosted the city when a new mayor took office. DC, Baltimore. They claimed they had government approval. Nothing ever happened. Dodger Stadium. They said it was ready by 2020. They removed the website by 2021. Never broke ground. Ontario Airport. Initial estimate $45 million. Actual estimate $500 million. They withdrew when environmental review was required. And then San Antonio Alamo Loop. The city selected boring in March of 2022. They never responded to the development agreement. They just kind of ghosted us. That's the history of these guys. And now they're like leeching. You know what it is though? Because the company is going public and raising capital, and people will become 100 millionaires, whatever, from owning the stock of this thing, the principals, and it doesn't matter whether it does well or not, as long as they don't get sued like Theranos, and they're not going to, because they're going to say, oh well, we tried to do it, it didn't work, what are you going to do? Meanwhile, they can take $10 million a year salaries and get bonuses and sell their stock and make a fortune just running the sham of a company. It's really insane. Anyway, but you see, the cool thing is, it's like I felt, when I gave it to John, I was like, I felt like that was the case, but I didn't want to start ranting and raving about it unless I was sure. And then he did the digging, and he found out that was the case, and he started ranting and raving about it for me. So all I got to do was read it. Kind of takes fun out of me writing it, but it is fun to read it. I mean, he just really goes off on this thing. But anyway, so again, the state of AI, the thing everybody's talking about as an abstract all over the media. And by the way, again, AI. Where's the AI on CNBC? Where's the AI on Bloomberg? Where is the AI on Seeking Alpha? Where is it anywhere? Who's actually using this stuff? And it's because it doesn't really work. We use it because we built a better system, because I knew it didn't work 3 years ago when I started playing with it. But then 3 years ago, I started developing better AIs. And 2 years ago, we came up with a higher level in artificial general intelligence, an AGI, and we've been refining our process ever since. So we've built better AIs that actually can contribute to a financial website and actually can scan for information and so on and so forth. So this is the future. You're looking at it. And it's amazing. The amount of research and processing and decision making we can do is phenomenal now. But it's not, it is practical. I mean, we that's what we're working on. We're working on developing this so that other people can have it too. But so far nobody else has the answer. We have this proprietary stuff that nobody else has. I keep expecting to see something being used on TV. Why doesn't Kramer have an Anya sitting next to him and saying stuff on the show? That would be kind of cool. And in fact, I'm talking to Bloomberg about on the Money Talk show that we do. I'm talking to them about actually putting one of the bots on TV, but I still need a visual. I still have to get the visual up and running because it's TV. They want to see it. But even when we're in the prototype stage with the Anya bots, we're gonna hopefully be able to put her on shows. And you guys have been. I got bored with it. I don't know if you guys are interested, let me know. But I had Anya. We were talking. We were talking to Anya live. Early this year, she was participating in the thing, and so is Warren, and so is Jubal. They can totally participate in this discussion that we're having right now. That works. There's no visual to it, but voice-wise, sure, they work. Let's see. Stefan says, SM Energy, SM, what are your thoughts on them? They have 300 million free cash flow this year, but supposedly over 1.7, blah, blah, blah. Okay. That's a chat question, because frankly, I don't know how many people are actually interested in what SM Energy does, but just so you know, I don't have Bodhi here, do I? Don't we do this all the time? There he is. Bodhi, yeah. Oh no, I didn't want a big giant report. What is this? Stop generating response, start a new thread to change sources. There's going to be way too much information. But notice that with Bodhi, because he's already trained and he's at an AGI level, I don't have to even explain to him what it is. God knows when the last time we talked to him was. Looks like some Fed decision time, so weeks ago. So he hasn't been spoken to since, obviously, since we did the last webinar. I don't have to tell him. I just put your question in there. That's the exact question. I just pasted out of the question box, and he knows what to do. Short answer, the 3 times PE is 300 million free cash flow snapshot is very misleading for SM. Our underlying cash generation and on a pro forma basis with the Citivis deal is not structurally broken business. It's a cyclical E&P that was just front loaded with CapEx and got punished hard. If you're comfortable with commodity risk and with the transaction, the sell-off looks more overdone than not. Below is the key evidence and how to think about it. Where they actually stand today. Let me see if I can get a visual on this thing. One? Is it just SM? Is that them? Yeah. So that's how they look. They're trading 5 times earnings. That's pretty freaking good, actually. Oops. All right, but the point is, here's your question. And all I do is drop this into Bodhi, and he answers the entire thing. So he's got a breakdown, he's doing the research, he's checking a dozen different things to make sure that everything is right. Why, look at this, why the consensus shows a big positive cash flow, pro forma with the merger, the 1.75 billion is essentially bullish. How overdone is the sell-off? The stock is down 53%, blah, 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 several valuation pieces. What broke the stock? Micro, key questions you should underwrite. Here's the deal execution. Holy shit. You realize how fast he told us this, right? So why the number is not the whole truth. It's third-party model using the latest free cash. So the 307 you mentioned is from a third-party model using the latest FCF, equity FCF, and incorporating the recent spending bulge. And he gives you the 2 sources he's using to tell you that. The company defined FCF is arguably better than that. Here's this thing to tell you. Over the last year, operating cash flows in the 1.5 to 1.6 billion range. It's structurally negative free cash flow, or it's different than structurally negative free cash flow. In other words, free cash flow hole is real on a leverage basis, but it's primarily timing and CapEx intensity, not a broken asset base. That's a good catch. This is a good little piece. This is a good little stock to buy. So is it attractive here? Positives, negatives, the risks. his take on a risk-reward basis at three times earnings, the beaten down share price after a 50-cent drawdown, the sell-off looks more overdone than justified, and he gives you more sources to look at. If you are comfortable owning a cyclical E&P through the commodity cycle, if you're willing to underwrite the integration as a regulatory risk, I would not build a thesis around the base case, but I do think re-rating even at 5 or 6 times mid-cycle EPS once FCS normalizes and the merger proves itself would imply substantial upside from here, even without heroic price assumptions. If you want, next step could be to sketch a simple back-of-the-envelope model at 60-70 oil and see what the free cash flow is. Oh my God. I used to work with Wall Street firms, and it used to take a week to get a report like this back, and it wasn't as good. And he's basically saying, hey, you want some more? Give me some more stuff. I can dig into every little nuance that you'd like. And that's what I'm talking about putting stuff to use. It would literally take him much longer to talk about this than it does to flash it up there. And I'm a fast reader, so this is, for me, there couldn't be anything better than this. It does not improve my turnaround time to speak to Bodhi on a microphone. It is the fastest way for us to communicate is for me to ask him a question and for him to flash stuff on the screen, and I can read it a lot faster than I just talked to you about it, and I can read it like bit, and immediately say, oh, I have a question about that, or this is bothering me, or what do you think of this? And between the two of us going back and forth, we come up with some really amazing analysis of things. Which brings us to the watch list. Oh, and by the way, so you guys will notice that we started, I used Signan and I used Zephyr for the watch list and not Bodhi. Why? Because Bodhi's expensive. Although it seems fast, and it may be fast, but doing all this is extremely processor intensive. So I get phenomenal output from Bodhi, but it's not a necessary, at this stage of the watch list, it's not a necessary amount of detail. As I start going over the watch list and refining it and being serious about what we're going to be buying for next year, then Bodhi will get more involved. But not when we're just at sort of this stage right now where we're saying, okay, we don't want this kind of stock, we do want this kind of stock, we like this categories, we like these sectors. This is not stuff I would waste Bodhi's talents on. So, Bodhi is very, very token intensive, very expensive to run. As are most of the AGIs. But the less expensive one, Zephyr, is on the Google platform, which is the cheapest for running large data series. And because he's a Gemini, Anya's a Gemini also. She's on that platform as well. Warren is cost effective. He runs on ChatGPT. But would I take somebody's question from chat and drop it in for any of those guys? No. Bodhi is the only one. I'm sorry, well, that's not true. So Bodhi and Quixote and Claude, the ones that run in Anthropic and the Bodhi on Perplexity, they're the ones that have been trained to a level where they can just handle this, where essentially he thinks like I do. And when there's two of us looking at the same thing, you're not going to get better analysis than that. I'm sorry. I mean, I've gotten paid a lot of money to consult and do analysis on many things in my lifetime, and they would fly me all over the country to check things out like this. So my experience is downloaded into this guy, and he is amazing. He is. Which means I'm amazing, I guess, but he's amazing. I mean, to have me at my disposal is amazing, and he's worth every cent. But it's a lot. So anyway, we went back through this watch list, and this is our our first draft, and we use the F, marry, kill system, which is, you know, do we like it enough? If it's new and attractive, it's an F. If it's stock that we're keeping in our list and working on, then it's a marry. And if we no longer like it, it's a kill, which is very simple. So our kill list here, out of the A through M categories, right? Because we did this, you know, I mean, we have this watch list goes back, well, this watch list has been active since the beginning of 2025. I'll give you an idea. Oof, it's so big it can't load. Here we go. So it's early August. The market looked like this in early August. We see this range. This is the range that now says, I do not believe we will fall back below this range. So, you know, there's I think that's 5,000. But we think we're going to stay up in the higher ends of this range now. But back then we weren't sure. Back then we thought we could fall all the way back down. And so this was the watch list in August. Now look how big the things are. Apple from old portfolio, blah, blah, blah. So here's our thing on Apple, recommend, still watching. AGNC from the old portfolio, here's what we recommend. ACAM, what we recommend. This is how the watch list is going to look when we're done with it. And this was Bodie and I working on each one and making little descriptions and sort of giving a thing on each stock that we liked. And the idea is, now notice these charts are self-updating, right? They've been updated since August. So we use a special kind of chart that self-updates. And that means anytime you open the watch list, you can see exactly where the stock is now. And very simply, obviously, if we're watching it, we tell you where we started watching it. So Apple's like totally gotten away from us as far as price. You can see where it is, where it was when we liked it. So AGNC $10. Now it's a little more than, now it was $9.50. Now it's $10.50. So it's still in the range where we like it. And that's the point. You can look at these visually. And so here you go, ARCB, say, oh, look at ARCB. Do we still, you know, is ARCB here? We actually had a discussion about ARCB where it was almost got killed, and I decided to pull it because I think I like it more than, I don't want to throw it out. ANF cruising along, right? So visually, you can easily see like who's worth taking a glance at, because you don't care about, you know, you're not going to look at AstraZeneca because obviously we liked it many, you know, 50% ago. Here's Barrick Gold, also too expensive right now. Here's Boeing. Oh, finally getting some respect again. Although really they're benefiting from Airbus having problems. That's really not a good reason to buy Boeing. Here's Baxter. Baxter's nice and cheap, but is it still a realistic thing to play? Here's Best Buy, which we liked back in August. And it's done very well since August, obviously. Barclays, but anyway, you can see how easy it is to use the watch list. So obviously Barclays got away. BHP is drifting along. BP is drifting along. Berkshire is high. BXMT is still pretty cheap. Very easy to go through the watch list anytime you want, and you have refreshed levels, and you can see exactly where it is and whether it's interesting in going. See, CIM, very interesting. I like him down here. So that's what this will look like once we're done with it, but right now it just looks like this. So here's the kill list. Here's what's falling off the watch list. Abercrombie and Fish, retail apparel, is not particularly something we want to chase. Cheesecake Factory, we had a whole, if the members remember, we had a whole conversation about the problem with these kind of restaurant stocks, and that the consumers are squeezing and their cost of squeezing. It's just not a good environment right now. Dollar General, surprisingly, the tariff concerns are squeezing their margins. They get everything. obviously they get everything from China, and you can't start sourcing your under $1 tchotchkes from Michigan and get things that you can sell, that you can buy for 30 cents and sell them for $1 and make a profit. That's just not going to be a thing. There's no such thing as dollar store items that cannot be made in China. And as much as you think that we worked something out with China, we did not. They said they worked something out with China, and nothing was actually worked out. We still have no solution to the China trade deals, and especially the de minimis stuff, which is small shipments from China of low price things. That's ridiculously taxed too, and it's not getting better. And by the way, talking about things that are not getting better, the frickin' Ukraine war isn't getting better. It was all bullshit. They just had a 4-day meeting that ended up being nothing. There's no resolution to that war. It was just Trump declared it over Thanksgiving to get his poll numbers up. It's freaking insane. Oh, not just to get his poll numbers up, but he has to do something Nobel Prize worthy by December 31st, or he's not eligible next year. Because the Nobel Prize that they give out late in the year is for things you did the year before, not for things you do that year. So Trump is under tremendous pressure, his ego pressure, to solve the thing. Oh, and Gaza's not fixed either. They're still messing around in Gaza. So not, all the stuff he claims he fixed isn't really fixed. It's just sort of like, teetering on the brink of destruction. And so if he doesn't wrap something up by December 31st, he's not going to get a Nobel Prize next year either. Very upsetting. So chemicals, demand and elevated input costs. Foot Locker, it's too ugly. Well, I love Foot Locker too, but they're too ugly. I think they got bought though. Didn't they get bought, or are they getting bought? Jack in the Box, another restaurant-y sort of stock. It's just they're not. It's not working for these guys. Kelly Services bad, Leibu bad, biotech is. What a shame. Biotech should be the most valuable thing in the market. It didn't just get displaced by AI, but Kennedy coming in, he's actually wrecked the entire biotech industry. So what should be another AI type of booming industry, fixing people, healing things, curing things. We were on the verge of doing all this stuff a year and a half ago. Now it's almost a dead industry. When the problem is the fact that you can take a company like Moderna that was that successful, that basically saved us from the coronavirus by coming up with a vaccine really fast and getting it out there and mass marketing it and so on and so forth. It was all done phenomenally well at the time. To take a company like that and then effectively legislate them out of business. That means that next time around, all the VCs who would have put money in are going to say, oh, I don't know. Because you never know what kind of batshit crazy thing the president's going to do to regulate these companies. They don't. Now, we are not regulating AI companies at all. They might destroy the world too. But we are regulating the shit out of the vaccine companies because Robert Kennedy thinks that they're causing autism just in his own brain, not that any study has ever backed him up in any way, shape, or form. Yet those companies are being legislated out of existence, while AI companies are not. The courts aren't even allowed to touch them. It's really insane stuff. This is like the kind of stuff like if you ever read The Rise and Fall of the Roman Empire, right? There's all these little scholarly things about like, oh yeah, the aqueducts, and they put the lead in the aqueducts. You can look back in history and say that was a terrible idea, right? This is a terrible idea. Right now, we're doing it. It's really obvious that this is a terrible idea, yet we're doing it. And when we're all gone, when we're all dead and buried, they're going to write a book and say, yeah, that was really stupid. It's like, we don't know what people were thinking at the time that they let this happen. So there's that. Oh, and toys. Oh, you can't have toys anymore either. That's another fun thing. So Mattel's no good. MGM, the consumer slowdown is very, very bad. If we have a recession, it's going to be very, very bad for these guys. I like gaming stocks. I like to play them, but he's right. It's not good. So then what are attractive new positions we're looking at? None of these are really cheap. AMAT is not cheap, AVGO is not cheap, CEG is not even cheap, and Duke is not cheap, but they're all worth watching because they will have huge, huge growth momentum on them. Broadcom, see, it's hard for me to say. I love Broadcom. Broadcom's one of my all-time favorite stocks, but it hasn't been cheap in a long time. Here, I love them. I don't at 375. It's hard to say. It's 40 times earnings. It's not, but it's 90 times current earnings. It's 40 times next year's earnings, and what that tells you is earnings are growing at an insane pace. So yeah, I like them even though they're ridiculously priced, because if you wait a minute, they won't be ridiculously priced anymore. And Broadcom is the ultimate pick and shovel play for AI growth. Look at these sales. Look at this. Look at they issued shares. Actually, unlike most companies that are buying back shares, they're like, here, have some shares. Give us money. We'll take you can have our shares. But that jump, which is significant, which is a 10% jump in shares, right? That causes a 10% decrease in earnings, right? 10% jump in shares means 10% less earnings per share, not dollar earnings, but earnings per share, and therefore you get a distorted sort of PE. So, and again, this is stuff. No, I would say maybe. I like to be modest, but I'm not going to be modest right now because I'm just going through all this crap with my AIs, and they're like, we're all catching stuff that nobody's ever caught before. That no other analysts are going to explain this to you or understand it, but you have to look at these things because they issued. It's not even 10%. It's like almost 15% more shares this year. That caused a 15% drop or 15% rise in their PE multiple, right? 15% is a lot. And but they're earning so much more money per share in the future that it washes through, and they still drop 50% less PE next year than they have this year. It's just insane. Their growth is insane. But see what the EPS does? So it really falls off the table here, and then it starts picking back up as the sales start kicking in. And so they should be a good solid play. And the thing is, I wish they weren't 370. I wish they would split. The problem is it's expensive margin-wise to play them, but I have super faith in this rising channel. So this channel, which is $50 wide, we could play this all year long. As they move up towards $500, we can take a spread and we can sell short puts below this channel. We can sell short calls above this channel, and we can have a good old time playing this stock. So the way we can play with the options, we don't need the stock to go particularly higher. We just need it to behave itself, and this one should be pretty well behaved in the channels. So there's more considerations than just one thing. So the way he talks about it, this is Zephyr's summary. Custom silicon infrastructure leader, despite their 40 times forward earnings, we're still looking at Broadcom as an interesting long. They're a dominant player in custom AI accelerators and essential networking geeks. The thing is, they sell their stuff to the companies that have money. I like that. They're not selling their stuff to OpenAI. They're selling their stuff to Google and Meta and people who actually have tremendous internal cash flow and have tons of money. And so when they say they're going to pay for something and when they're going to build something, they do it. And AVGO has incredible margins, and nobody can just step in and do what they do. They are the leaders. They've been the leaders for years. They're going to continue to be the leaders. And so they just happen to be kind of expensive now, but not so expensive that I want to walk away from them. Constellation Energy and Duke, of course, are doing the grid growth, and the grid demand is going to go up and up and up. Then stocks that we're sticking with that we like: Apple, Akami, Zeneca, Barrett Gold, Berkshire Hathaway. None of these things should surprise you, right? It's like, I'm not saying any of these names and you're going, what? Caterpillar, Cleveland Cliffs. That's the point, though. That's how we build our portfolios. We don't build our portfolios on surprising companies. We build our portfolios on companies that you're like, well, duh. It's like, so Phil, you like blue chips, huh? You know, where's the creativity? I don't want to be creative. You know, if you're moving into a new house and it's all dirt around your house, right? You don't take peas from the freezer and throw them out in the yard and say, I wonder if these will grow. You go get some freaking Scott's Miracle Grow and you spread it around with the thing, the device that spreads, you know, the thing you push around that spreads the seeds, and you water it on a regular basis, and lo and behold, grass. Right? And if you plant the tree, you go to the tree store. This shows you how much I plant a tree. I did. I swear. Once when I was young, I used to actually do that kind of stuff. But it wasn't me. It was my dad. I did it with my dad. Okay, I confess. I did it with my dad. He made the decisions. But we went to the garden store, and the garden store guy said, "Here's your seeds, and here's what you do, and here's the starter pot and all that." So I've been involved in the process. I do know there's a process, but you don't. So in other words, you don't get the lemon trees and say, wouldn't it be great if the lemon trees grew up in New York? Then we'd have lemons. Let's get some banana trees and some lemon trees and some orange trees and plant them around the property, and we'll be the only ones with orange and lemons and bananas growing in our yard. And it's like, no, you don't do that, because that's not how it works. You do get some pine trees and some maple trees and some oak trees, and you put them around the property, and 30 years later, you have all these great trees around your property. You know, I've moved out and gone to college by then, but you never know. I took my kids back to my old house. It's literally covered in, like, you know, it was an acre and a half of property, and it is now forested, basically. It's got so many big trees and gigantic things, and we planted all of it. When I was a little kid, we planted all that stuff, and my dad had this vision, and it's exactly what he thought it was going to be. But he sold that house, I think in 1987 he sold that house. But here we are 40 years later, and it's it's a forest. It's that thing, the video, the man who planted trees, right? My dad actually did that. He actually planted trees around the property, very intentionally in very certain places, and he nurtured them. And it always seemed like, well, what's this ever going to turn into? It's like, but it did. Even when I was living there, the bushes between us and our neighbor grew up to become a bush fence, basically. So we had our yards were separated where they weren't separated before, and we had privacy for the pool, which my dad also had envisioned putting there. So the point is that, this is how you build a healthy portfolio. You build it with obvious things. You don't put lemon trees where apple trees grow. You have to say what is good for this environment, what's going to be good for the future, what's going to last through the storms and through the warmth and through the cold, and what's going to survive. Because you're making an investment, and if one of your trees dies, it's not so bad if one of them dies, but if half of them die in 10, 15 years into the project, you're going to have a hard time starting over. You're not going to live long enough to see it come back. So that's what these core positions are. They're not meant to be risky stocks. They're not even meant to be gigantic growth stocks. I mean, Cisco's kind of a growth stock, but I don't care if they grow. We just want them to know that they're consistently going to be there, and they'll grow. They'll keep up with inflation. They'll move up 1, 2, 3, 4, 5% maybe in a year, but we're not swinging for the fences. Here we want good, reliable, solid stocks that should perform in the environment that we anticipate over the time we plan on owning them, which is the next decade. And that's why these are all like Oh yeah, Caterpillar. Okay, so you know, where's the big choice in that? Comcast, CNX Railroad, Cisco. Oh yeah, Cisco. Don't they connect everything to everything else? Yeah, that's why we like them. There's going to be more things. There's going to be drones and flying cars, and there's going to be robots and delivery robots and things like that. Oh, I was in where the hell was I? Miami. I was in Miami. There's little square delivery robots all over the place running around. It's already happening. I mean, literally almost any street corner you're at in Miami, you will see a delivery robot going somewhere. And it's funny, by the way, psychologically, it's very, you know me, I'm like following them around to see what they're doing. It's very interesting because I know you've seen videos of people like kicking or attacking delivery robots and stuff, but the predominant thing that happens in use in Miami anyway, and you know, maybe some cities have different attitudes towards robots, but in Miami, it was fascinating to me the number of people who would stop and take time to help a robot that was having trouble. So in other words, if there was a robot that was at a difficult curb, or if there was a puddle in front of it, and you can see its distress because it goes back and forth and turns a bit, and you can see that it's worried or like concerned about what's in front of it, and you see people like helping it and suggesting to it like what to do. Not that it necessarily understands, but it's very funny to see people like trying to help the robot navigate its way around. And you know, nobody was stealing from you. And this is Washington, where of course Trump says, I'm sorry, not Washington, it was Miami. It's Miami where Trump is saying like people are mugging people in the streets and whatever. And meanwhile, nobody's robbing it, nobody's bothering it. People are trying to help these robots. They're like just sitting there thinking, oh, you poor little fella. And that's the future. It's really interesting. CVS, good steady thing. Disney, EPD, Energy Transfer, Freeport, copper just went through the roof. They're a good one. Gilead, General Mills, cereal. Oh, who's going to have cereal in the future? Corning, who's going to use glass? Like who's going to have phones with glass in the future? Google, IBM, Johnson Johnson. You know, blue chip, blue chip, blue chip, blue chip. That's the portfolio. We make our money selling stock premium, selling options premium against our positions. So we're looking to make an income from our holdings. You know, there'll be a few growth stocks that we like, but the main part of our portfolio, in fact, here's the growth stocks. This is the ratio of growth stocks. We'll have some growth stocks, but mostly steady, 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 steady. Not even 20% growth, 15% growth maybe. I'm not taking risks. If an industry or a sector is turning out, we don't want it. We're not trying to be heroes. We are going to take the picks and we're going to take picks and shovels, picks and shovels, picks and shovels, picks and shovels, picks and shovels. We're playing the AI growth without picking a single AI stock. Or I guess Google is an AI stock, but Google makes their money. Google makes their money in other ways. AI is not their primary focus. That's what I love about it. So that's our list on this group. That's the early part of the alphabet. Let's see if there are questions. Nope. Microsoft would love my perspective. Not without a check. All right. So who are we killing on the back end? Nike? Too messy. They're such a disappointment. I really thought they could overcome it, but they're not. New Tech, Simon Property, who I really like Simon Property, but they're not cheap, and I don't see the growth. Black & Decker, Synchrony Financial. Oh, did we leave him on the kill list? That was our trade of the year. Subprime consumers. I'm gonna have to think about that one. I missed that. I would have probably taken that off the kill list. We already, this was our trade of the year. We already made the money. Oh. We made the money early in the year because we picked them up. What happened to them? So we picked them in November. We made great money here. We took it off the table. We made so much money so fast that we took it off the table. Then the market crashed and we got back in. Then it went back up here and we took it off the table. Then it went back down here and we bought it again. So we're on our third round of owning these guys. So it's our third trade of the year. But the original trade of the year was back from Thanksgiving. And so I guess around here was Thanksgiving. So November 22nd. So we picked them up for a good price, under 65. It went up to $70 something, and we took the money because we were worried about the market. Then it crashed. Then we jumped in again. Then we had this run, and then we picked it up again. So we love these guys. They're still trading at 8 times earnings. I don't think they're overpriced. I understand his point that subprime consumers are a problem. I would want to see what their mix is, though, and take a close look at that. And that's the kind of thing I do with Brody. I'd say to Buddy, do you really think they're worth killing? That's all I'm going to do. I'm going to take this to Brody and I'm going to say, Zephyr said this, but I don't necessarily agree, and I really still think they're a good bank, blah, blah, blah. And we'll see what he says. Trivago, worried about travel. Two Harbors is a REIT that I don't love, so I'm not worried about them. Walgreens, I gave up on a while ago. They just cannot get it together because this is a falling knife we have no interest in catching. Xerox, I don't know what Xerox even does anymore. Here's our new ads, NVIDIA. I don't agree. I wouldn't chase NVIDIA. PPL and Southern is good. Has more power. It's a little bit. We're not going to buy every power company, but we'll see who looks strongest. Pan West. I do like the AI security space. I'm not sure I want to chase Pan West either. Core Holdings, Newmont, Annaly, On Semiconductor. We already have most of these. Pepsi, Pfizer, PG, Qualcomm, who I like as much as I like AVGO. Restoration Hardware. I love these guys. Rio. Again, copper is huge because copper, you need the copper for the power. See, it's everybody thinks about like, oh, chase AI. I'm like, well, how are you going to build these data centers? Because that's what it's all about. Everybody's building data centers. So yeah, NVIDIA puts the chips in the data centers, but there's nothing to put the chips in unless you build the servers and the rack space and the cooling towers and all the wiring and so on and so forth and the electricity plant. And then you've got to build the nuclear plant to run the whole thing. There's a lot of people who make money if they build data centers that have nothing to do with all these 50-to-1 earnings companies. There's great companies that you can invest in, like copper companies, because you need a shit ton of copper to make all this work. Rocket I still like, Schlumberger I like, SoFi of course I love, AT&T I always love. I don't care what the market is. No matter if I ever have to close my eyes and pick a stock, I'm going to be like generally like unless AT&T is $35, I want to buy it. And that's another one you can see easily. 25. That's a weekly chart. This is a monthly chart. Yeah, it's never 35, so I take that back. It's never actually 35. But under there, obviously 30 is the high part of the channel, and 20 technically, or you can say 15 or 16 or whatever. But it really is here. It's about 18. So 18 is basically the bottom of the channel. And 30 is the top of the channel. So we're not low in the channel, but I don't care. They're not going to go bankrupt. So I'll buy them. And if they get cheaper, I'll buy more. And if they get cheaper, I'll buy more. I don't care how much AT&T I own. You know, you're never going to go to me, Phil, you have too much AT&T. I'm like, do I? I'm like, great, then sell some options and draw some income off it. I mean, it's hard to imagine why I wouldn't want it. Tech resources, Target, like I think I said before, big turnaround thing. Treasuries, don't know if I agree with that one. United Health, too cheap. Yeah. UPS, love UPS because UPS. Oh, where's he getting this from? Margin recovery. They fired Amazon. That's my premise. He's got my premise. They fired Amazon to focus on higher margin business to business freight. They're yielding 7.8%. It's a real value. It pays dividends. It's fantastic. Vitaris is another good one. Verizon, obviously, same as AT&T. Whirlpool, stupid cheap. 80% of their sales are manufactured domestically. It's good for them if tariffs are high. It's good for them. And right now they're down because of tariffs, because nobody, investors don't actually pay attention to the company. They're like, oh, they make appliances, therefore they must be getting hit by tariffs. They don't check to see where their appliances come from. They just lump everything in with the same. This is where marketing opportunities come from, though. When you know something that other people don't know, that's your advantage in the market. There's Exxon. They make money no matter what happens. They're just a money machine company. And Yeti, I still love Yeti. I don't know where they are right now, but I think Yeti was that stock of the year a few years ago. Like that, like here. I mean, we called it right. It was like down here, it went flying up. So yeah, they're on the rebound. Oh, look at that shit. See, but it doesn't matter where they've been. The question is, what are they doing? They're 15 times forward earnings, right? So they're on a reasonable track to start making money. Back here, they look very exciting and sexy, and they were growing like crazy. But then COVID and the retail sales petered out, blah blah blah. So now they're back on a more on a track, but people have lost their excitement for it. But they're still a good, consistent grower. They should break out of this and head up to around 60. Their sales certainly deserve it, and they're growing nicely. Look at this. Look at these sales. And what are they doing? They're buying back their stock. They bought back 5% of their stock in 2024. So and that improves their EPS, right? That improves their EPS, but their earnings also, their sales are also going up. They're in good shape. They're getting tariffed. They're working through issues, but they are working through it. And the consumers of Yeti are inelastic. Not only that, though, but their margins are fantastic. So this is something you have to realize about tariffs: is if somebody is importing from China a $10 plastic cup of Target, right? And it costs and it has a good markup, and it's $5 coming out of China, and they mark it up 100%. But now there's a tariff, so now it's $10 coming out of China. Those guys are screwed. Okay, but Yeti is selling you essentially the same thermos for $80 that other people are selling for $40, and Yeti and the other guys are both buying them out of China for $20. So when China has a $20 has a 100% markup on the thermos, now China is sending it to Yeti for $40 instead of $20. But Yeti's still charging $80. All that happens to Yeti is their 70% margin or 80% margin drops down to a 50% margin, but they're still making 50% selling the thing. Plus, they can turn around to their customers and say, hey, this is now a $100 bottle because we got to pay a tariff. And the kind of people who are buying an $80 thermos aren't going to say no to a $100 thermos, especially if they put a fancier logo on it or something like that. So, it's just, and by the way, Yeti, their stuff is better in the same way that, you know, when you look at like really good clothes at like Neiman Marcus or something like that, or Bloomingdale's, and you're like, well, this is a better shirt. It's got nicer cotton. It's got this and that. The buttons are sewn better. It's done nicer on the edges. It's got a better fit. This and that. You know, all that stuff costs a little bit more money. And top 10% consumers don't give a crap about. They'll pay for the quality. And that's what it is. They'll pay for the quality and they don't really care about how much. You know, this explains why restaurants are so, why good, you know, why there's so many expensive restaurants. There are many, many people who eat, and there's enough people who eat and also have incredible amounts of money that there's a predominance of very expensive restaurants around. You know, as you know, there's quite a difference in the quality of food from one place to another. It's the same thing with a Yeti thermos. It's like, you know, it's like I could easily buy a $40 thermos that basically does a good job. The Yeti might be 10% better. You know, the ice will stay colder in it for you know, for the ice on the Yeti will still be there 24 hours later, whereas the other thing, after 12 hours, my ice will melt. But functionally, that's not really a problem. I wasn't going camping for 24 hours. I'm only going on a hike, and I'm going to leave. I'm going to take my car. I'm going to carry my thermos, and I'm going to go on a hike that's going to be 2 hours, and I'll be back. And the whole day's worth of stuff will be less than 12 hours. I'll still have ice in my thermos. I don't need the better thermos. There's no logical reason for me to pay the extra money, but I do. I like the fact that my thermos is better than the other thermos. That's how all quality stuff works. And if you're in the top 10%, and you're making, I think top 10% is like 180,000 a year now. If you're in the top 10% and you make 180,000 a year, you're not even in the same planet as people who are making 60,000 a year. Because their take home is $30,000. And they've got $2,500 a month to spend, and they've got to figure out where every penny is going, including their rent and so on and so forth. You know, even if you're paying 40% tax on $180,000, let's say $200,000, so then you still have you still have $140,000 left to spend. And unless you live in a super duper expensive place, your disposable income is 100 times what the other guys is. So it's not even the same, like I said, not the same planet. When you're buying things, your considerations are completely different than a regular person. And that's why companies like Yeti exist. That's why RH, I'm saying RH, they're not worried about a recession. As long as it doesn't affect the top 10%, it doesn't affect them. And oh, I just ate lunch at RH. Holy crap. RH has a restaurant in Palm Beach, West Palm Beach, one of those things. And I just went there for that. I never went before, but they have in the RH building, which is all like floors and floors of furniture and stuff. They have on the rooftop a restaurant. It was fantastic. It was expensive, but not crushingly expensive. And by the way, I'm a New Yorker, so nothing in Florida, nothing is expensive. There's no such thing. I've never had a meal in Florida where I've been like, Jesus Christ. Whereas in New York, that's like a weekly event. So, but for Florida, it was expensive, and but it was amazing. It was delicious, fantastic. It was as good as any restaurant in New York. So it was a very amazing place. But anyway, so yeah, so that place was full, and the furniture store was full. The whole place was full. They have valet parking. You pull up to the furniture store, valet parking. Rooftop restaurant, little alcoves everywhere with salespeople and people talking and decorating catalogs and blah blah blah. Believe me, those guys they're having a good time. They're not worried about the tariffs, and they're not worried about this and that. Whether they're worried about the tariffs. Oh no, this couch is $5,000 and it was $4,000 last year. It's like, no, that's not going to turn their customers away. So and again, notice PE falling from 30 to 13. Yet the stock is languishing. So I love these guys going forward. So that's how the watch list works. We build it like that. We go over it, and I will be obviously detailing those kind of things. But this is a nice quickie thing of what we've been discussing so far. We're betting the top 10% remain resilient. RH is shifting away their sourcing from China down to 2%. Oh, good for them, man. To mitigate tariffs and demand has risen. And by the way, that's easy for RH to do compared to Target, because Target, 30% of their stuff comes from China, but it's stuff that everybody wants. Whereas RH is full of, like, I don't want to say unique, but unique as in you're not going to see it in other furniture stores. It's not unique like there's only one of them, but RH is ordering from the top-notch houses in every country. They're importing, like, from Malaysia and China and Japan and whatever. You know, they're importing from all over the world the finest stuff, the finest furniture and the finest utensils and everything else, and all the fixtures. Everything that they do is imported from, like, incredible places. So for them, if you say, oh, we're tariffing China 100%, they're just like, okay, don't order from China. There's 5 things in the warehouse from China, and they'll sell those, and they won't order more. That's all. Done. That's how come they can knock their imports from China down to 2%, like snapping their fingers. It just won't be in the showroom anymore. Very simple for them. But Target can't tell you we don't carry that plasticware anymore because it's from China. You want that stuff. You want those Target things. All the picture frames and whatever. They come from China, and they were $5 and now they're $10. But there's still nowhere else to get picture frames for $10 or less. So Target has to try to carry the Chinese stuff, even though it got more expensive. RH doesn't have to do that. They're just going to find another really nice picture frame from some other place, although their picture frames are $500 instead of $10. And that's the way the world works, right? So perfect timing. We'll end it on that note, and things will progress. It will already be the 10th next week, but we won't be, then our portfolio reviews will come out again. And then it'll be Christmas, and then the year will end, and then it will be 2026. So you can see why there's this urgency to get prepared, right? We have to be ready for what we're going to invest in next year. So stick with us, and we'll make sure you're ready. All right, thanks, guys. Have a great weekend.